Ladies and gentlemen, good day and welcome to Radiant Cash Management Services Q4 and FY23 earnings conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sohail Halai from Antique Stock Broking. Thank you, and over to you, sir.
Thank you, Neerav. We welcome you all to 4Q FY23 and FY23 earnings call of Radiant Cash Management. Today we have with us Mr. Colonel David Devashyam, CMD, Mr. Venkataramanan, CFO, Ms. Jacob, Director Operations, Mr. N. Muthuraman, Director Strategy and Investor Relations. I thank David sir for giving us this opportunity to host the call, and without further delay, hand over to him for his opening remarks. Over to you, David sir.
Good morning, ladies and gentlemen. Thank you, Sohail, for your introductory remarks and for coordinating this call. I'm Colonel David Devashyam, the Chairman and Managing Director of the Radiant Cash Management Services Limited. Along with me are the members of my senior management team, our Chief Financial Officer, Mr. T. Venkataramanan, our Chief Operations Officer, Colonel Jacob, and the Director of Strategy and Investor Relations, Mr. N. Muthuraman, who many of you have seen by my side in the run-up to the IPO, who will be taking on most of your questions. I'd like to thank all the institutional investors, the high net worth individuals and retail investors who continue to repose their faith in our company. I would also like to thank all the analysts who joined us in today's call. We look forward to a fruitful and engaging discussion with you all. I'll begin by an overview of our company's performance for the last quarter and for the full financial year ending 31st March 2023. Revenues for the quarter ending March 31, 2023 were at INR 89.7 crores. The EBITDA for the period stood at INR 22.1 crores, with the reported PAT being INR 15.5 crores. The numbers are incomparable on a sequential quarter-on-quarter basis, as third quarter tends to be our strongest quarter due to the festive season. For the financial year ending 31st March 2023, revenues were at INR 354.9 crores, registering a growth of 24.1%. The EBITDA for the period stood at INR 89.7 crores, growing by 50.8%, while PAT stood at INR 62.7 crores with a growth of 64.2%. As you can see, it has been a fantastic and eventful year for the company. We wish to keep growing and strengthening our endeavor further year on year. I'll hand it over now to Mr. N. Muthuraman to take you through the key performance indicators. It's over to you, Muthu.
Thank you, Colonel. Good morning, everyone. Thanks once again for joining this analyst call. I'll present the update on operational KPIs and will try to link the same with our various business verticals. We are present in over 13,000 PIN codes across 5,700 plus locations in India. This has been our strongest USP, as a wide network helps in servicing maximum number of clients, thereby improving our route density and hence our profitability. We handled 1.57 trillion of cash in FY23. This reflects a 20.6% growth over FY22. We provided our service at 63,420 touch points during the year FY23. Comparative figure for the previous year was 49,980. As we had mentioned in our prospectus, as well as in earlier in this call, we continue to add 1,000 to 1,100 points every month for the last 3 years. And this is the growth driver of our first business vertical, which is cash pickup and delivery. This segment accounted for 69% of our revenues, and the number of touch points is the key growth driver for this vertical, because we charge our banks a fixed amount per point per month. This segment grew at 28% year on year. %63% of our revenues in FY23 came from Tier 3 plus locations, where we have our strongest presence. This is also a key growth driver for our second vertical, which is network cash management or cash burial. For those of you who are attending first time, this is business where we pick up cash from end customer and deposit in Radiant's own bank account and then electronically transfer to our client bank. Electronically transfer it to the client bank where they do not have a branch presence. So this is a value-added service that we provide to our clients, and this segment accounted for 18% of our revenues in FY23. Tier 3 plus locations have limited branch presence, as against the 61 bank branches per lakh population in urban area. India has only 6 branches per lakh population in rural areas. In such areas, this value-added product of network cash management helps our client banks offer this service to end customers even where they do not have a branch presence. This segment for FY23 reported a flat growth over FY22. A combination of reasons for this flat growth. One, lower throughput in the petroleum sector. We spoke about it briefly in the previous call as well. Lower throughput in the petroleum sector, which are predominantly network cash management clients. There is some marginal pricing pressure from banks on the burial cost. Also, the revenue mix of newly added points were in favor of Tier 1 cities, where burial revenues form a very small component. We expect 2 of these 3 reasons to revert to mean, namely the petroleum sector as well as revenue mix to revert to mean shortly. While we have taken significant measures to control costs on this front, and our gross margins have remained fairly stable in FY23 over FY22, despite the marginal pricing pressure. As on March 23, we had 840 cash funds and a staff strength of 9,297, including 2,172 employees and 7,125 contractual workers. Of this, 21% are from armed forces, a strong USP for Radiant, which has helped to keep our cash losses to the minimum. For the year 23, our gross cash losses before insurance claim was about 6 crores. The impact on the P&L is much lower, in fact, slightly lower than the P&L cash loss impact in FY22. We added about 24 clients in this financial year, all of whom are direct clients. This has helped increase the share of direct clients in our revenue to 2.9% in FY23 as against 1.5% in FY22. We serviced over 3,200 end customers in this period, up from 2,675 in FY22. All of these have helped generate very healthy ROCE of 33% and a return on equity of 27% for this year. More importantly, we generated cash flow from operations after working capital changes of 73 crores in FY23 as against 31 crores in FY22, a growth of over 135%. I now request Colonel to share his concluding remarks.
Well, I would like to thank you all for making time to join us for the call. It's always humbling to hear from our investors and larger analyst fraternity. We will now endeavor to take your questions and feedback with utmost sincerity and incorporate the learnings in our mid and long-term business plan.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. The first question is from the line of Lakshmi Narayan from Tunga Investments. Please go ahead.
Yeah, thank you. A couple of questions. First is, what part of your revenue is directly linked to the value of cash you actually handle?
Yeah. The second segment, which is the network cash management, is directly linked to the volume of cash we handle. The third segment, cash processing, is also linked directly to the volume of cash that we handle. So these two together is roughly about 24% of our revenues. 18.5 and 5.5, about 24% of our revenues will be directly volume linked. Our main business, which is network cash pickup and delivery, it is not exactly directly linked one-on-one to the volume of cash that we handle. We charge a fixed amount per point per month for this segment. Yes, it has an indirect linkage in the sense that we have, as the limit for daily limit goes up, the charge goes up, but it's not exactly directly linked to the volume of cash that we handle. Hope that answers your question.
Yeah, that helps. Second, what kind of capital expenditure as a business you would incur in the next 5 years? Annually.
Yeah, why don't we take that on?
Yes. This year in FY23-24, our capex expenditure will be to the extent of about 25 to 26 crores, mainly to be incurred on cash funds to be purchased.
Got it. And this will be refreshed every couple of block of 5-7 years, so that will be a recurring capex for you, right?
As we had mentioned in our prospectus as well, this is a one-time insurance against any eventuality. So otherwise, today we have 840 vans. All of them are on lease. Substantially, all of them are on lease. Very few vans are in our books. The prospectus and the purpose of the IPO was to raise some amount of capital to acquire some vans in our books as an insurance measure, but we'll continue to avail these vehicles here on as well.
So is it fair to assume that your annual capex will be in the range of 20-25 crores every year?
No, only this FY23-24 will be an exceptional year. Last year the capex is about 3 crores.
Got it. So only this year you will have a higher capex, and that's predominantly for these things. Okay.
Yes.
And sorry?
This year, based on the price issue, we had a certain amount of money coming in for purchase of cash funds. As Muthu was elaborating, we are now buying some cash funds to be sectoral reserves and available, in case there is a shortfall of a vehicle from many of the leasing organizations from which we are getting. So just to make it that, we are going in for about 200 vehicles which will be in our inventory. Otherwise, there is no, as Venkat just thought out, our CFO, the year before the capex was just 3 crores.
Got it. And what led to a higher operating cash flow to almost 75 plus crores this year? It's a great achievement when compared to last year. What led to it, and what is your plan for the day? Will it be this range going forward, whether this kind of higher cash flow from operations is stabilized now?
Last year in 22, PBT was 52 crores. That has increased significantly to 84 crores in March 23. That's the major reason why our operating cash flow has increased. There's an increase of about 32 crores in the PBT.
Mm-hmm.
See, operating cash flow has increased from 31 to 74 crores There's an increase in 43 crores. The major amount has come from the PPT increase, and the balance has come down from increase in working capital. Our receivables have generated about 7.5 crores. These are the two major reasons for our increase in cash flow to the extent operating cash flow to the extent of 40 crores during the year.
The tight control on receivables is one of the key reasons for this year. We hope to continue to remain so in future years as well. With last year, cash used in debtors was about 8 crores. This year, we are able to reduce the debtor levels over last year and 7 crores positive. Net impact over between last year and this year is a 15 crore delta.
Got it. And one last question from my side. You mentioned that there is a throughput reduction in the petrol pumps, right? And that has actually led to the second segment being flat. Now, why do you think that has actually happened, and why you think in the next 1 year things will kind of ease up? That's what you mentioned in your initial remarks.
Well, in the petroleum sector, you are aware that once the pricing was brought down, so particularly among the privately driven petroleum companies, there was a move to move their resources into an export orientation, and that's the reason we found that the sales of these particular bunks went down drastically. In fact, it has had an impact. We had we had wanted to conclude with a much higher PAT figure if possible. But this had an impact on this. But then this is slowly now we find month on month it is slowly growing. And we feel that it will over this year slowly stabilize and come back to near normal as what it was before this particular phenomenon.
And you don't cater to public sector petrol pumps, this is only for private? Is that the reason why it had a larger impact?
Yeah, it is largely private sector, because public sector, we do a very limited extent only for the company-owned, company-operated outlets. Those are very far and few. The rest of it, the cash management, as in it has to come through direct clients, because individual franchises decide how they want to handle their cash. As private sector, it is decided at the corporate level. And to add to what the CMD just mentioned, the private sector has built a large petroleum infrastructure, as in petrol bunk infrastructure. I don't think they will let it rot. This is an opportunistic time to capitalize on the differential in export pricing, because Europe cannot directly import from Russia. So I don't think this is going to be a permanent situation. Things will revert to mean sooner than later is what our expectation is. Thank you.
Got it. Thank you. I'll come back in queue.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Prashant Kutti from Sundaram Mutual Fund. Please go ahead.
Yeah, hi. Thank you for the opportunity. Just wanted to check with you. One is in terms of the commissions. Have the commissions kind of come off as compared to what we were probably charging in the past? Because when we look at the touch point number growth and the kind of cash managed in the system, they don't seem to be kind of coinciding with the revenue growth number.
No, there has not been any reduction in the commissions, Prashant. In fact, our points growth and our the cash pickup and delivery revenue growth are matching exactly, 27% and 28%.
No, I'm not asking on an annualized basis. I'm asking for the quarter. So if you look for the quarter, your touch point number and your sequential growth, there seems to be a drop, whereas your touch points have actually increased. So I'm just trying to understand that point.
Yes, the sequential growth is because we had explained even last time and even earlier roadshow presentations. Q3 is our best quarter because of the festive seasons and holiday season. So core tend to be slightly lower than Q3 in the past as well, and that's what has happened in the current Q4 as well. The point that we add in this quarter may not reflect significantly on revenues immediately. It will take its own time to start generating the revenues. Because if it starts with the lower threshold, it will be throughout from January to March. Every month it will get, every day it gets added. So immediately that number will not reflect in our revenues. Sure.
No, but surely, got your point. But typically, when we've always said that we would want to kind of maintain at least a 20% kind of a growth rate, against that the growth rate, I understand that there is a moderation on a sequential basis, but given the fact that we are in that growing phase and given the fact that we have been actually increasing the number of touch points, this year has almost seen a 25% plus kind of a touch point improvement. Is it because that a lot of them have been tier 3? That's why maybe the throughput is not so big, or any thoughts on that? Because if I just look at the revenue number for the kind of scale of operations and the size of operations that we're doing, 15% seems to be a lower number, given that we've always in the past also guided for about 20% number in terms of growth rate.
Yeah, the 15% is because of what we just explained. I mean, the petroleum sector did have an impact on it.
Yeah, yeah.
We were forced to reach that 20% plus, and our guidance remains so.
Sure, sure. And that thing is right now largely done in terms of the one-off which is there. How much was the impact of that? I'm sorry, I missed out that number in case if you give it.
Yeah, so the numbers are there in the KPI table. As in there is a net impact on the top line of about 8 crores.
8 crores.
Yeah.
Is it addressed right now?
Slowly getting addressed, not fully.
Understood.
It's a slow month-on-month growth we are witnessing, but not as rapidly as we had hoped for.
Which is why it probably also explains the EBITDA number also kind of getting impacted as well, right?
That's right. As we had explained in the past also, I mean, we are a high operating leverage company.
Sure, sure. Understood.
We see that revenue growth of 25% for full year resulted in a PAT growth of 64%. The thing with operating leverage is that it cuts both ways. So
Sure, understood. The point of mentioning you added a lot of clients in the last year. What kind of sectors these clients would have gotten added into in the last 1 year? Any thoughts on that?
Yeah. If you could look at the sectoral composition of our revenues, you can see that we have had a fantastic run in organized retail. It was 11% last year. It moved to 15% this year.
That's right.
E-commerce and e-commerce logistics continue to remain at about 24.5%. Petroleum was down. Railways, we had a fairly good growth. I mean, it's not reflecting in the proportion because the overall revenues also grew. Railways have good growth because of the restoration to pre-COVID levels. And others have also grown. I mean, as I had mentioned, our focus has been on direct clients and improvement in the direct clients, almost 100 basis points over last year, 1.5 to 2.9, more than 100 basis points. So this across diversified sectors.
Sure. No, I just specifically asking when you said client addition, and since a large amount of clients have gotten added into organized retail, and you used to earlier talk about maybe QSR outlets or for that matter, jewelry outlets. Just want to understand that, are we kind of seeing that happening? That is what I want to check. When you're saying organized retail increasing, is it that you're seeing a number of outlets? Is it being QSR outlets getting added, or is it jewelry outlets getting added, or is it fashion retail outlets getting added? Is this what you're seeing?
I will not be able to put a number on which of those sub-segments within organized sector has given us the maximum contribution. But I mean, if I have to put the topmost, it will be like the organized routine, as in like more retail and Reliance retail and those kind of numbers. Those are the ones which are getting maximum added.
Understood. One last point from my end, you've actually seen a significant amount of increase in the touch points covered. What's the outlook going forward in terms of touch point addition? We've almost seen a 27% increase. Should we kind of still maintain that you'll be adding about 1,000 outlets per month? Is that the way one should look at it?
Well, currently we are looking at that, and we have a large number of end customers. This is driven by the end customers, like our clients are the banks mainly, but the end customers, each of them have their own growth objectives. So any additional touch point outlets or retail stores that they keep adding on, that organically that just keeps increasing our numbers. And so we are confident that this particular number will be maintained and it will be sustained over a period of time.
Sure. Thank you so much and all the very best to you.
Thank you. Good questions.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Aegis Lakhani from Unifi Capital. Please go ahead.
Yeah, hi, sir. My first question is that, you mentioned about, the loss of petrol pump revenues in the third quarter. But we were under the impression that, since you are adding 1,000 to 1,100 touch points every quarter on the cash management, wasn't there an offset, for growth in revenues that came through because, the shortfall was only 3 to 4 crores per quarter. So didn't that play out where, the segments where you were growing could catch up for that missed revenue? Could you first clarify this?
Just to give you a generic answer to this, you see, the petrol bunk, the individual pickups are fairly large. And this is volume based because the entire thing is network cash management. So that for us is an extremely lucrative segment. And that's the reason why we had this impact in the last quarter. It is continuing this quarter and it has impacted us to an extent in this financial year. But at the same time, the same breath, I like to say that it has been a fantastic year on every other count. And whatever we had hoped to achieve and we set out to do, this was in some ways a kind of force majeure. But I'm very sure that this will be overcome in a few months in the coming year.
Noted answer. Again, just to reiterate, you mentioned that there's a recovery taking place in this account of, that you're referring to. So could you call this out more clearly? Is it that, the loss which you are facing in terms of business of 3 to 4 crores is at least the business has restarted and, you're seeing a certain percentage of that 3 to 4 crores, that ground being covered? What exactly is the recovery here?
The recovery is, that earlier the sales were really very high. Let me give a number. Let's say it was 900 crores.
Okay.
Now that has come down to, let's say, 150 to 180 crores.
Okay.
And the recovery that we are seeing is on an average about 25 to 30 crores additional growth month on month. So there is a steady growth, but it is taking some time. And we hope that over time it will come to that old level of 700 to 800 crores per month.
Got it. So my second question is, you mentioned in your opening remarks that there is a margin pressure from banks. So could you explain, exactly what is the margin pressure? Is it happening on renewal? Is it happening in the steady state business? Could you speak more about this?
Yeah. So this is specific to the network cash management segment where we have a flat growth over last year. If you see our KP also, we were at 64 crores last year and 64 crores this year as well. And so it's a combination of all these 3 points. One is the tier 1, higher share of tier 1, where network cash management business is not warranted. And some marginal pricing pressure. So these are specific individual deal level pricing. I mean, you can compute, we have given in KPI, we have the volumes and the pricing is there. Very marginal, but correspondingly our costs have also come down. I mean, if you see the corresponding bank charges, it is slightly lower than last year. So the net margins on this sector, on this segment is healthy and remains as it is. I mean, there's a limited growth in this segment because of these 3 factors, 2 of which we believe are temporary and will quickly revert to me.
Got it. And sir, you used to earn, give or take, 1 rupee for every 1,000 rupee transferred in that ballpark range. So is that 1 rupee under pressure? Is that what you're saying?
No, we've cut down the cost also. So the margins between FY22 and 23 have remained the same, if you can see that.
Okay. And sir, what are the kind of, segment level margins? So if I were to just ask you that, say cash pickup and delivery, what kind of, EBITDA margins does that segment have, and what kind of margins does the network cash management have?
Okay. We cannot put mathematically also we cannot give segmental margins because the same infrastructure is used across all these verticals. Only thing that we can give is for network cash management, which I have already said. There are bank charges that is disclosed, and there is the burial network cash management revenue that is disclosed. That is the only segment where you can even impute a gross margin level. EBITDA cannot be given segmental because it is the same infrastructure is used across the sector.
Got it. And sir, it was our endeavor to, pay a higher dividend, that we had called out. So could you just speak regarding the dividend?
I had said that we would be a strong dividend-paying company, and if you remember in the last quarter, we had declared a dividend of 1 rupee per share, and now we have included as of yesterday's board meeting. Of course, we'll be taking to the shareholders of 2 rupees per share that we'll be declaring. So that is our stated policy, and we'll always be, we'll try to abide by that.
The dividend payout ratio, these two together?
Can I give the dividend paying ratio?
Yes, sir, about 52%, sir.
Yeah.
52% is being paid as it is.
Sir, it's 2 rupees on an EPS of 6 rupees, right? So that will be roughly 30%. Please correct my understanding.
You take 1 rupee interim dividend also we are paying.
Okay. So this is the final dividend. Okay.
Yes.
Perfect. I have understood what you're saying.
We paid 1 rupee in January 23.
Okay, got it. And sir, just finally, if I can, just ask you that what do you think investors should sort of pencil as your growth drivers for FY24, and what should we be monitoring?
Sorry, can you just repeat the question?
So I just wanted to understand that your growth drivers for FY24, what should we be, observing for, and how should we be thinking about growth in 24?
Yeah. Drivers of growth, like we mentioned, as in the point addition, quarter on quarter, what is the number of points that are getting added? And only these two, as in volume of cash that we handle. So volume of cash that we handle affects about 25% of our business. Points that we add affects about 70% of our business. The rest 5% is the cash and operations. So there is one small temporary issue that we have because of this 2000 demonetization. There could be some. I mean, if you could see this even in the Q4, there's been a good jump in our cash and operations. Okay, cash in transit business. We could see some bump in that because of the ongoing 2,000 rupees, not exactly demonetization, but a quality of.
Yeah, with regard to the 2,000 rupee note, we'd like to say that it's only comprises of 10% of the cash in circulation. And so over last year itself, most of the banks have been restraining and holding back the 2,000. They have not been giving it to the body public. So it's only less than 10% of the overall volume of 2,000, which is currently in the hands of the body public, and that is now coming back. In terms of our cash pickup, I feel that now quite a few of these will get utilized in the different outlets as well. So personally, I feel that with over 24% in 500 of the cash in circulation, 24 lakh crores in circulation being 500, there's going to be a very marginal impact on us in revenue terms.
Got it. So this will be a added tailwind for the next at least 6 months. Or, sorry, 4 months.
1 quarter, yeah. Some marginal ones, yeah, that's right.
Yeah. Thanks, all the best.
Thank you. The next question is from the line of Aditya Sharma from Aditya Birla Sun Life. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I want to understand the levers that you talked on the network cash management. So the share deteriorated because of the poor mix in the tier. So we added more touch points in the tier 1. So just want to understand how is the touch point addition currently? Is it still is the mix inferior? As in, are we adding more touch points in the tier 1? So that is one. And in terms of the second, I want to understand when you said there was some pricing pressure from the bank, was it limited to a few clients or was it pervasive across clients? And how do you see that going forward? Will the share decline further in FY24? So if you could just answer these questions around network cash management.
With regards to your question, what I'd like to say is, as you've seen, the growth has been in the retail segment. Now, organized retail, we are seeing there has been a lot of growth, particularly in the tier 1 and tier 2 locations. And in these locations, typically the network cash management segment is always not as strong as it is there in the tier 3 and tier 4 locations.
Right.
So that's the reason why there has been a marginal impact of this. And for your second question, I'll ask Muthu to take it on.
Yeah, there is no, even individual client-wise, there is no pressure like that. It is individual deal-level pricing for specific end customers. There are some negotiations.
Okay. Okay. So according to Colonel David, so the mix will continue to remain inferior, and that would actually hamper both in terms of reducing the share of network cash management in the coming years, and also the margin profile would be weaker because I would suppose this is the most lucrative segment of our company.
No.
Is the understanding?
No, yeah. Not necessarily. See, this is one particular quarter and last 2 quarters where few large retail clients, organized retail clients, added more in the tier 1 segment. But over a longer period of time, we have observed that the growth in tier 1 is saturated for many other segments, and the growth in tier 3 and tier 4 are the ones which drive maximum amount of growth. In our presentation, if you see, there is one slide which we have talked about, say, for example, even e-commerce from various tiers. Only 37% of the revenues are from tier 3 plus today, and that number could go higher because as the penetration improves. So over a period of time, we expect that the share of tier 3 will improve from where we are today, and which would mean network cash management also will continue to improve.
Got it. So also, I want to understand the idea in terms of the margin expansion was that there is inherent operating leverage in the business, largely stemming from almost fixed employee costs. So the employee costs would grow around 7, 8, 10%. But what we've seen as a percentage of sales, the employee cost has been constant at 17%, while we have delivered a strong growth. And so if you could help us understand why that is and what is the way forward.
Venkat, would you like to take this on?
Yes, sir. The employee cost in 23 is about 17%. 16.9. 17%. We expected to come to around 15.5% in the current year, in 23-24.
Probably what you're doing is, sir, you're adding other other income in the revenue, which I am excluding. So that is why if we exclude that, you'll get around 17% odd for both these years. So I'm just trying to understand, like it. So
there's a 0.4% improvement. Would have liked to see a little higher, as in like he mentioned, as in it could be like as in we mentioned in Q3 results also. If you see our Q4 employee cost vis-a-vis Q3, it is actually a reduction. Okay, so those so we don't expect the employee costs to continue to grow in line with the revenues. Revenues guidance is at 20%, whereas employee costs will be in the range of 10 to 12%.
Right. And also the other operating leverage that we were talking about, that half of the other expenses is more or less fixed, the van charges, etc. So just want to understand, while the growth has been great, but the margins have been quite lackluster, just talking in terms of expectations. And so how do we build in terms of the margin profile going forward? While you're guiding for around 20% growth, the margins that we were expecting, the delivery has been quite lackluster. If you could help us understand how to look this forward.
See, the margins are definitely better than last year, but not as much as we expected, because the petroleum sector, as in, see, like I said, it cuts both ways, right, as in the operating leverage. We lost about 8 crores of revenue in petroleum sector. If it had come through, there would have been hardly any additional cost, which would directly have resulted in significantly higher EBITDA numbers. So that was in a sense, a post measure. We expect it to revert to mean and much healthier margins going forward.
Right. So two things are happening. One, it is already in the base, and second, you're saying that situation is reversing. So probably next year we should get an added benefit while it is in the base, and second, we are making progress, and the operating leverage continues to kick in. So we expect the EBITDA margins to expand going forward in FY24.
Yeah, you can expect that, Aditya.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of Agastya Dave from CEO Capital. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes, sir.
Sir, you have actually answered the questions, but I'll just to get like a final closure here. Please tell me if my understanding is wrong. If I look at the margin pressure that you're talking about, the pricing pressure, that's purely because of mix, right? If I look at like for like, if I look at tier 1 and compare it with tier 1 last year, and if I look at tier 3 and compare it with tier 3 last year, the pricing has not changed. It's just the mix which has changed. Is my understanding correct, sir?
Sir, our pricing is never based on the tier.
Okay.
Our pricing is across the, we just sign up long-term contracts with the bank, and irrespective of which location it is, whether it is within city limits, beyond city limits, or far off location. That is the only thing. Whether there is a bank branch within 5 kilometers, 10 kilometers or not.
Right.
So it doesn't matter whether it is tier 1 or tier 2 or tier 3. So our pricing across the banks is okay.
So whichever way you want to look at, I don't know the reality because I'm very new to the company, but if I look at on a like-to-like basis, on a location-by-location, like-to-like basis, the pricing has not changed. Whatever has happened is because of the mix change.
To a large extent, yes.
Well, that's what I got out earlier during the discussion. If some pricing has changed, it is in the new deal level pricing which is coming up, where we are trying to differentiate. But we already have strong operating leverage, so we may be able to absorb that.
Understood.
Otherwise, there is these are long-term contracts with fixed pricing, and there is no change in that. It's across all tiers.
Understood. And whenever these contracts are up for renegotiation, the prices at least keep up with inflation, or they are again like rolled over at the same rate?
Well, there have been twice, so far historically, twice there has been an increase in 10%.
Okay.
But, otherwise, normally year on year, many contracts are for a year on an annual basis and auto renewal that happens.
Okay.
So therefore, the pricing is not a matter of, negotiation every year or every time we count for.
Right.
For a renewal.
Okay, understood, sir. And sir, you mentioned several times that there is a lot of operating in the business, and if I go by your guidance of 20 to 22% growth, and if I extend it far into the future, there is always a ceiling in every business beyond which margins cannot increase. So, in your business, is it fair to assume that, let's say, that ceiling could be around 25, 26, 27%? Like, is there a number beyond which you cannot theoretically go because obviously you'll have to increase your costs? So, is there a number?
On the nature of business, currently the whole industry together is doing about 1.6 to 1.7 lakh outlets.
Yeah.
While the available opportunity is over 30 lakh outlets.
Right.
Market, and it's only a small segment of it which has got, if you look at the US market today, which is, 85% is organized retail. Compared to ours, growing to 20%. Now there 65% of the organized retail is done by Metro Cash Management Company. Retail cash management company. The cash sector.
Right.
So we are just at the start point of this, and to feel as if there is any, that year after it's already a mature market or it's reached a certain level, I think that would be too premature to take that kind of a view.
Sir, I completely agree with you on the opportunity set on the revenue side. You can keep growing for a very long time at a very decent pace. All I'm asking is in terms of costs. There is obviously an operating leverage as you have discussed, but is there an upper limit? Like, for example, can you ever be a 30% EBITDA margin business at triple the scale? So let's say today, if you are approaching 350, 400 crores, but let's say when you become a 1,500, 1,600 crore company, will your margins be 30%? Is there a limit beyond which the margins cannot go? Because the additional costs kick in.
Yeah, fixed costs are still fixed costs. Yes, you are. Theoretically, what you say is right. We have not given our guidance on the margins in future. But one thing we can say is that today we are not anywhere near hitting the ceiling.
Great, sir. That is exactly what I wanted to understand. One final question, sir. You mentioned that next year you'll be doing 20 to 25 crores of capex. So what will happen to our depreciation going forward when these are fully capitalized? Can you give some number to that? Will we see doubling of our depreciation?
This year our depreciation was about 45 million. Next year our depreciation will be around to the extent of 65 to 70 million. That's all. 65
to 70 million, right? And then roughly at that level going forward, right? Because this is an exceptional.
Right.
65 to 70. Great, sir. Thank you very much, sir. All the best.
Thank you very much for your lovely question. Thank you.
Thank you, sir.
Thank you. Next question is from the line of Gaurav Nigam from Tunga Investments Private Limited. Please go ahead.
Yeah, sir. Thank you for taking my question. Sir, I have two questions. I'll start with first. Sir, what is the number of points per beat that we serve as on date, and what has been this number over the last 3 years, FY21, 22, and 23?
Sorry, the number of points
per beat.
Number of points per beat. I don't understand the question. Can you repeat?
Yeah, your vans go to on a beat basis, right, in a particular route. So number of points that you service on a per route basis.
See, we don't have, it's a wide-ranging number. There is no fixed number that I can put. But you have a sense, we have serviced 63,000 plus points in FY23. And we have about 7,000 plus cash executives. Okay. So this number is disclosed in our RSP as well and in the presentation that we uploaded yesterday. So you can get a sense, roughly about 6 to 7 points per person.
Okay. And is there a possibility of increasing it, or we are near the ceiling of number of points which can be done?
No. There are, I mean, as I told you, it's a wide range. There could be some routes where it is only 2 points to some routes where it is 28 points also.
Oh, 28 points also. Okay. Got it. So that will depend on the density of the shops that we are servicing.
That's right.
Okay. And sir, how many visits is done by per van on a single day? On an average?
Please repeat that question.
I mean, how many visits are done by per van? Like, how many routes are done by one van on a single day basis?
So each van, Colonel Ben, would you like to take it out?
Each van generally runs a one route only in case of cash pickups and delivery, because they start in the morning at 10 o'clock and then till, say, in case of bank deposit, they work till around 1 o'clock, 2 o'clock, go to the bank. Or in case of vaulting mandate, they come to the vault by around 6 o'clock. So it's one route, and the van route is so designed that maximum points are picked up in the van.
Understood, sir. Sir, this number cannot become two, right? In the business construct, it will always.
Gaurav, sorry to interrupt you. Can you please speak through the handset?
I'm speaking to the handset only. Sorry.
Hello.
Yes.
Gaurav,
Hello.
sorry, but
Is this better?
Yeah, now it's better. Yeah.
Yeah. Sorry, sir. Question is, this number of routes, will it always remain one for the business construct that we are in?
That's right, because the cash deposit, banks don't accept cash deposits beyond 3 p.m.
Understood, sir. Okay. Perfect. Thank you, sir, for answering my question. Thank you.
Thank you very much.
Thank you. Next question is from the line of Hina from DAM Capital Advisors. Please go ahead.
Hello. Hi. Thank you for the opportunity.
Hina, can you please speak a little louder, please? You're not audible.
Yeah. Am I audible now?
Yes.
Yeah. So, the first question that I had is basically continuing from the previous participant about the growth levers for the business, basically. And of course, you indicated that touchpoint addition would be one of them, and increasing your network currency business. But could you probably pinpoint industries that would be contributing to the growth?
Yeah.
Yeah.
What we had witnessed in FY23 is that fantastic growth in organized retail and very good growth in BFSI and both e-commerce and e-commerce logistics.
Sure. Yeah. No, but I'm saying going forward, what can we expect?
So we expect that these 4 segments, as in all of them, will continue to contribute fairly heavily.
Okay, e-com, BFSI, and retail.
BFSI, e-commerce logistics, and organized retail.
Okay. And for your network currency business, is there any way of pivoting away from being, the concentration on petroleum industry is too large? Is there any way to pivot away from that? Some industries that could possibly, add to this business?
Sorry, can you just repeat the question? I missed the first question.
Yeah, so the reliance on the petroleum industry for our network currency business is too high. So is there any way of pivoting away from this, adding other industries to the mix, which could, possibly in the future, in case there's an impact here, it wouldn't be a huge one?
No. I don't think that's a correct statement to make. Yes, it is the other way. I mean, petroleum industry, a good part of the business enjoys network cash management. Network cash management is not dependent only on petroleum. It is from across various sectors. across all sectors.
Okay. And just last on the pricing pressure, I know there's been a lot of questions, but just one thing that I wanted to clarify was the pressure is coming on new deal additions. So is there competitive intensity rising or probably some competitor cutting prices is why customers are asking for a lower price?
I don't know, something wrong with your voice. Can you just probably adjust the microphone and speak again?
Yeah, I am on the handset. What I was trying to ask was on the pricing pressures, specifically on the new deals. Is it because the competitive intensity has gone up or there's some competitor cutting prices? Is why clients are expecting a lower price?
There is no such increase in competitive intensity. It's maybe marginal unintended effects of us going public. They're seeing a healthy margin.
Okay.
Level pricing negotiation. But we have a very strong relationship with all these banks for 15 plus years, 17 years.
Sure.
So we don't expect that to have very big.
Okay. Thank you so much. Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Raju Baranwal from Antique Stock Broking. Please go ahead.
Yeah, thank you for the opportunity, sir. My question is on the new business area that you are looking to venture into, the diamond, jewelry, bullion, metals. So could you please help us understand that the opportunity and competition in this segment, and by when one can see the revenue additions on these segments? So could you please elaborate on this?
No. So we have just taken a board resolution to amend the article as an enabling provision at this point of time. We feel that it is an adjacent market which can have a significant scope, and probably we can utilize our strength in handling high-value cash to similarly replicate in diamond, bullion, and jewelry. But at this point of time, it is just an enabling provision. We need to get the shareholders' approval, and thereafter we may think of it. It's too preliminary for us to give anything concrete.
Okay, sir. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. As there are no further questions, I now hand the conference over to the management for closing comments.
Well, I must thank the analysts for some wonderful questions. They set us all thinking. And I thank you very much for having taken the time to attend this call and posed all those interesting questions. To conclude, I'd like to say that at the core, we're a network management company operating with the rigor and discipline of the armed forces. I'd like to reinforce that at the core, we are essentially a network management company operating with the rigor and discipline of the armed forces. We take great pride in our culture and see it as a platform in exploring business opportunities in adjacent as well as new age businesses. I want to emphasize our appreciation for the trust and confidence you have placed in our company and promise you of our commitment to deliver long-term value to our shareholders. Lastly, I'd like to thank Antique for having taken the effort for having hosted the call this morning, especially Sohail Halai. Thank you very much, Sohail. And thank you very much, all of you.
Thank you, David, sir, for sharing, and the team for sharing the insights. And wish you all the best, sir. And hope to stay connected. Thanks a lot, sir, for your time.
Thank you very much. On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.